These are the only 4 ETFs that anyone needs to hold if they want to build wealth in the stock market. I know this sounds a little too easy, but trust me, as someone who reached financial independence in my 30s, this is the exact investing formula that I followed and will continue to follow. So join me today in this video as I share with you my top 4 stocks that I am buying in 2025 into 2026. And if you stick around to the end, I'm going to give you a 5th bonus investment that surprisingly has been generating me a guaranteed 11% returns each year. That sounds like a plan. Pop a squat, tap the thumb icon, and let's get into it. 1. Every portfolio needs a strong foundation, which is going to act kind of as a core investment, and this is what you're going to build the rest of your portfolio around. And this oftentimes is going to be more than 50% of your total portfolio. And one of the most proven and effective strategies has been to purchase ETFs that can track the entire US stock market. And my favorite ticker symbol for this, and one of the best ones, is VTI, or the Vanguard Total Stock Market Index Fund. The objective of VTI seeks to track the performance of the CRSP Total US Market Index across large, mid, and small cap equity diversified across growth and value. In other words, the total US market. VTI has exposure to roughly $3,500 companies with a median market cap of around $219 billion. And some of the top holdings in VTI currently are companies like Nvidia, Apple, Microsoft, Amazon, just to name a few. And this is one of my favorite things about ETFs and index funds as a whole, in that you don't have to call the winners because the winners eventually do just rise up. For example, Nvidia. I don't think many people had Nvidia 5 years ago, 8 years ago, 10 years ago. However, if you were holding VTI, you had it. And as Nvidia has kind of just rocketed to the moon, you have experienced that growth along with VTI over the past 2 to 3 years. It's one of my favorite just kind of set it and forget it modes of investing. Now let's talk about performance. Over the past 10 years, VTI has returned on average a 14% return per year, which means if you invested $10,000 10 years ago, you'd be looking at a return of roughly $37,000 today. And when it comes to dividends, VTI really isn't a dividend play, but it does kick off some. This year, we're currently looking at an average dividend distribution about 1.4%, which means if you just bought $10,000 worth of ETI today, in a year, you'd expect to get about $140 worth of dividends back. Personally, my recommendation, when those dividends come in, go ahead and just reinvest it. I think there's a lot of magic happening when investing in VTI, mostly in the sense that it's a set it and forget it, and you've purchased the entire US stock market. Really, the one thing I want to highlight is how much it costs to own the expense ratio, which is going to cost you just a mere 0.03%. And ladies and folks, when it comes to investing and investing long-term and being a successful investor, it's important to have good returns. It's, I would argue, even more important for your overall financial well-being to keep the expenses low. And 0.03% is very, very low too. Now let's leave the US for a second and look overseas, because every great investor knows diversification isn't just about owning different stocks within the US. In fact, if you only own stocks in the US, that's actually called home country bias. And that is a big no-no. No. Diversification is also about owning stocks internationally. And for that, one of the best international ETFs you can own is ticker symbol VEA, also known as the Vanguard FTSE Developed Markets ETF. With VA, it seeks to track the investment performance of the FTSE Developed All Cap ex-US Index. This means you'll have exposure to roughly 3,900 companies spread across Europe, Canada, Japan, as well as Australia, though not limited to just those regions, with a median market cap of a little over $48 billion. Some of the top holdings within VX include companies such as SAP, which if you didn't know, I actually used to work there. Again, I'm not biased or anything, but it is the top holding and the largest software company in Europe. ASML, a major player in the AI space. Toyota, no explanation required there. And to round it out, Novo Nordisk, which, if you haven't heard by now, Ompic anyone. Now let's talk about performance. Over the past 10 years, Virginia has, on average, returned just shy of 7.9% a year, which means if you put in $10,000 10 years ago, you'd be looking at a total portfolio value of $21,300 today. Now, I do want to address a very common critique you're going to see all over the internet about international stocks, and that is the fact that they underperform the US stock market, which that is true. For the past 15 years, the US stock market has been on an absolute tear. But if we go back to the early 2000s, the 80s, internationals outperformed the US stock market. And even this year, if we look at the performance of VA to date, you're looking at a return of a little over 24%. While we contrast that to VTI, which is the total US stock index, and that's sitting at a little north of 10%. Now, both of those are fantastic returns, but as you can see, internationals have absolutely dominated the US. My point isn't that one is necessarily better than the other. My point is this is why you want diversification, so you can capture upside on either side. side. And as always, folks, past performance is never indicative of future results. This is just a point around diversification and its importance. And as for the dividend that VA issues, it's 2.6%, 6% is the latest we've seen, which means if you went ahead and bought $10,000 worth, you would get an annual dividend of $260. And similar also to VTI, the expense ratio is very low, coming in at just 0.05%. As it comes to VA, I hold about 20 to 30% in my overall portfolio, and I like to think of them as my passport to the world when I'm not actually traveling. In addition, I focus specifically on the developed markets, not emerging markets. The issue that I typically find with emerging markets is one, there's usually some political instability. But the second and the most important is the fact that we can't always 100% trust the data coming out, for example, economic data coming out of China. And so because of that, I'd much rather just leave my money in the developed markets. 3, now that we have our stocks covered, we do need to add in some stability and income, especially near retirement. And this is where bonds come in. I know, not the sexiest topic, but you can count on bonds to always deliver. In the bond ETF that I hold is called BND. BND tracks the Bloomberg Aggregate US Float Index. With BND, you'll have exposure to roughly 11,000 bonds, 70% of which is government, and the rest is made up of high-quality corporate bonds. And the credit rating is typically from AAA to B, and it definitely excludes any type of junk bonds. Now let's talk about performance of BND. So if you had invested 10 years ago, your average return that you would expect to see per year would have been about 1.8% a year. So if you put in $10,000 10 years ago, you'd have roughly $11,953 today, which honestly, that's pretty meh. But that's not why we buy BND. Remember, it's about stability and income. So now let's look at the dividend yield. BND distributes a shockingly high 3.77% dividend. So if you were to buy $10,000 of BND today, you would get an annual dividend yield of $377. It's also in line with the rest of the ETFs we discussed and having a very low expense ratio coming in at just 0.03%. Overall, I think of BND as a shock absorber in my overall profile. It kind of evens out the ride when things get bumpy, and we've certainly had a couple of bumpy months and years recently. In fact, just this year, BND year to date is sitting at 4.97%, which is pretty high for a bond fund. Now, if I were betting man, I wouldn't bet that it lasts. However, it's very nice to capture a little bit of the upside when we have a little bit of turbulence. Now, if all of this sounds complicated, which hopefully it doesn't, but let's just say it does, and you are having a difficulty finding investments, what to put in, what the ratios are, and you really want to work with a financial advisor, please, 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 for the love of God, do not work with a traditional financial advisor that charges you a percent fee of your portfolio size. Those people are leeches. You lose money, they make a ton of money. Not good for you. Try to find an advisor that basically charges what's called a flat fee. So like a fixed fee, $1,000 a year, $2,000 a year, so on and so forth. Because with those people, if your portfolio appreciates, meaning it gets bigger, you don't pay more money, which honestly just makes more sense. Now, advisors don't do that because they don't make as much money, but that's the way the industry should be going. Even though it should be going there, I'd say 98% of advisors are still the traditional percent fee advisor, which is bad for us. But again, this isn't sponsored at all. I personally use a service called Facet. They've been really good. It's just flat fee only. And so I know if my portfolio just, 10x's in a year, I still paid the same amount of money versus if I had a traditional advisor and my portfolio 10x's, guess what? My fee 10x. So if you want to check out Facet, I do have a referral link in the description box down below. 4. Now let's talk about one of the oldest and most proven strategies to obtain wealth, and that is through real estate. And we have a couple of options to do so. One is through an ETF. Oh, well, I guess specifically it's called a REIT, a real estate investment trust. A ticker symbol I would look at is VNQ, the other way to invest in real estate. Now, it's not as who's just a normal person to obtain significant wealth in their lifetime. And here are the 4 reasons why I believe in physically owning real estate. The first one, leverage. Imagine you wanted to go buy $1 million of Google stock, but you only had $35,000. Do you think the bank is just going to loan you $970,000 plus? Probably not. Now, instead though, if you wanted to buy, let's say, a multifamily property in Boston and you want to use a $3, 5% down FHA loan, you could in theory purchase a $1 million triplex in Boston, come in with $35,000. The bank lends you the rest and you're in. Now, it's obviously a buy and hold rental, so it's going to be a living house hack, but like that is to me such a crazy concept. You come in with so little, the bank comes in with the rest. But at the end of the day, you own the property, and as long as you manage it correctly, you get to cash flow. You're going to reap all of the benefits. Leveraging real estate, absolutely top notch. Second reason, tax benefits. There's way too many to name in real estate. I'm just going to highlight one, which I think is beautiful. It's called depreciation. So basically every single year, this structure, this building that I am in the views of the IRS loses value. value. Now, in the open market, it actually appreciates, but in the views of the IRS, they say, hey, your building has to be depreciated over 27.5 years. And so every single year it loses a little bit of value. That value that it loses, you can take and write it off against your taxes, which again, wait, let's back it up. So you're telling me this thing every single year, if I list it on Zillow, it probably appreciates, 2%, 3%, 5%, 10%. But I actually go to the IRS, I can basically claim a depreciation, which is kind of like a loss I can write off against my taxes. What? Again, is that happening with stocks? Absolutely not. 3, appreciation. We bought a property in Boston. It was a duplex for $600,000. A year later, I went to do a refinance of the loan. That thing appreciated $150,000. Basically, it reappraised for $750,000. That's pretty much 25% appreciation year, which is insane. Now, again, it's not going to last forever, but for the most part, if you look at buying healthy real estate in healthy markets, the graph tends to go up and to the right. Reason number 4, inflation. Folks, at the end of the day, we've seen it over the past 3-4 years. Inflation is everywhere. What is inflation? It's the price of goods and services going up. Now, what could be a good or service? The house that you buy and then you rent out. Because if you rent it out, guess what is factored into appreciation? Rental prices. And so if we think about it, inflation is up 5%. Well, I have to raise rents 5%. Inflation's up 10%. Rent goes up. Now, I'm not saying I want to do this. That is just by very nature the way it works out. But all I'm saying is it's a great inflation hedge. Price of goods and services go up. Great. My rental prices are also going to go up. Of course, buying physical real estate is great. There are some downsides. You have to be a landlord. You have to be capable in being able to analyze properties and really buy in the right areas. In addition, contrasting it to a REIT, it's not as liquid, right? I buy a house, I've got a house. I can't just next day turn around, I'm out. I got to go into another one. It is a little bit slower to move in and out of. In addition, that the other contrast with REITs are you're investing in a REIT. And a REIT is really the company that's investing in real estate, whereas if you have direct ownership into real estate, you've got tangible property to hold on to. Overall, for real estate, I think this is still where the bread and butter is for most folks. If what you're after is financial independence or wealth acceleration quickly, you're going to be able to do it with all the other things I talked about earlier. But the thing with real estate is I just see it scaling a lot faster for the common person, thanks to the most important principle we talked about earlier, which is that leverage principle. And for those of you still around, now let's talk about that bonus investment category that I'm seeing 11% returns a year. It's in the segment of alternative assets. Now, I know you're probably thinking real original alternative assets. Yes and no. So I'm not talking in the crypto space. What I'm talking about specifically when it comes to alternative assets is actually private credit. And the way I access private credit is through the Fundrise Opportunistic Credit Fund. So what exactly is private credit? Well, instead of just owning equity in something, private credit, you're kind of acting like a bank. You're lending out money to projects, to developers, and in exchange you get interest for it. It can be kind of thought of like a bond. However, because it's private and typically a lot less liquid, you can earn a higher interest payment. And that is by way of being a hard money lender in the world of real estate. So let's say someone wants to buy a fix and flip property and the bank doesn't want to loan to them because this investor doesn't have a track record or the bank doesn't feel good about the asset. Well, they go to somebody who, let's say, has $50,000 and they go and borrow that money for a year with like 20% interest rates. I'm kind of making these numbers up, but that is kind of like what private credit is. The difference though is instead of just one person in one project, it's a fund looking at massive projects. I'm talking millions to tens of millions, potentially hundreds of millions of dollars on the line. As for the type of returns you might expect, the Fundrise Opportunist Credit Fund targets returns between 9 to 11%. And so far it's delivered roughly that 11%. This year it's actually on pace to hit about 12%. Now let's talk about some of the requirements. This particular fund does have some pretty steep requirements. Though in general, to get into investing in alternative asset classes, there are going to be some requirements. And typically they're going to be coming from the private banking arm of, say, JP Morgan or Citi or Barclays. But this specific one requires you to be, one, an accredited investor. The second is that it's a closed-ended fund, meaning you can't just go and put money in. In fact, there's a waiting list, and the only way for you to get in is when they want to raise more money, and they'll let more investors in. As for accessing your money, it's actually pretty illiquid. So once you put money in, it's tied up for 0.5 to 7 years. One of the interesting things about alternative asset classes, specifically about private credit in this space, is the fact that the Fed has tightened some of their lending practices. Banks are tightening some of the lending practices. So it's tougher for some projects and builders to access money. And so they are going to go onto the secondary and private markets. And that's really where this fund plays nice in the opportunity, in the opportunistic fund, is the fact that simply most people can't just go and lend to a builder that needs to go and borrow $10 million. However, in aggregate as a fund, you can lend there and you can capture the upside, which is those interest payments that can be kicked off of it. As for fees, there are some pretty steep steep fees relative to the earlier ETFs we discussed. So you've got a 1.75% management fee. In addition, there's a 20% incentive fee over a 10% preferred return. This might all seem pretty crazy and shocking, the amount of fees you're paying, but net of the fees, typically the returns you're looking at are anywhere between 8 to 9%, which is more or less in line with VTI that we saw earlier. And to wrap, private credit is really interesting. This type of fund is really interesting, but I definitely don't think it's for everyone. You have to, one, be comfortable in understanding what it is, and two, have all of your bases covered first with the earlier investments we tell about before you start putting money in here. But if you do, it's been a great bellwether in down years, especially earlier this year when the market was down anywhere from like 8 to 15%. Now it's recovered a little bit more, but the Fundrise Opportunistic Fund was still kicking out that roughly 11 to 12% annualized return. So that's the video, folks. These are the only 4 stocks that I'm buying for the rest of this year, plus a bonus investment topic. And the stocks are, again, VTI, VEA, BND, and real estate. And the bonus investment vehicle we're taking a look at is invest in an alternative asset class known as private credit by way of the Fundrise Opportunistic Credit Fund. If you have any comments or questions, drop it down below. This has been a great video as always. Love seeing you guys, and until next time, peace.